Hello friends, welcome back to part 7 of my Tesla earnings forecast video review series. I'm joined as always by my co-host Loki, who just put his head down. He had his head up a second ago. Let me share my desktop with you and keep the party rolling. Hopefully you've watched parts 1 through 6 in my forecast review video series, and you are just here to see more charts explained by me, the person who created the charts. So the next one that you'll find in my forecast thread on Twitter that by now I have already tweeted out and will include the link in the video description below, so you can go check out that thread if you want. This chart is showing the 2018 CEO Performance Award quarterly expense, how much expense was recorded on the income statement for each of these quarters. And I won't try to delve into the accounting deeply for this one because it's too complicated to put in a short video. But this is done. Tesla has already expensed all of the possible expense that could have been expensed under this plan, $2.283 billion. I've been telling people for years is the maximum damage that could be done to Tesla's income statement by this compensation plan. And as of Q4, Tesla hit the last, 4 or 5 million bucks worth. Yeah, 4 million bucks worth. And that's the last little thin slice, the last step on this staircase is now done. So Elon is now working for free at Tesla. He's not receiving any hourly wage or any salary or any bonus, performance or guaranteed of any kind. He's literally working for free now at Tesla, so expect for there to be another incentive-based performance award given to Elon. We don't know what that'll look like yet. The board of directors needs to determine that. They have a compensation committee that decides that. No more news on this chart. It doesn't need to be extended to 2023 and beyond because no more expense is going to hit related to the 2018 CEO Performance Award. The next chart in my forecast thread shows Tesla's average revenue per delivery versus automotive gross margin excluding regulatory credits as a percent of revenue. That's a mouthful. There's a lot of going on in that title. Okay, so what is the mountain range here in the background? The gray area chart. This is the average revenue per delivery. So the y-axis labeled on the right is giving you the average revenue per delivery over here. Then the other y-axis is giving you the scale for the bars. Now, it's questionable if I even need to show an axis over here because I do have the percentages labeled above each of these bars. So you can see how much the automotive gross margin excluding regulatory credits. I threw out the regulatory credits, so nobody can argue with me that they're being artificially inflated by regulatory credits. What do we expect for Q1 of 2023? We do expect there to be a 5 percentage point hit to automotive gross margin excluding regulatory credits here due to price cuts and, the cost per vehicle still being pretty bad, Shanghai being pretty inefficient these days with some shutdowns for Chinese New Year, etc. So that's what's going on here. What happens after that? Well, I do expect recovery. So by Q3 of 2023, I've got higher margins than Tesla reported in Q4 of 2022. And then by the end of the year, Q4 of 2023, back to a 27% automotive gross margin excluding regulatory credits, which is more than any of the previous 3 quarters. There were some pretty high numbers here in late 2021 and in the first quarter of 2022. But expect there to be improvement throughout the year in 2023. And yeah, the reason for creating this chart in the first place is because Zach Kirkhorn mentioned during one of the calls how remarkable this achievement is to have your average selling price, your revenue per vehicle, decrease by this much as these bars are trending upwards, right? That's very hard to do. This means Tesla was cutting the cost per vehicle by more than the revenue per vehicle was falling, right? Otherwise, you wouldn't be able to achieve gross margin improvement, excluding regulatory credits, unless your cost per vehicle was declining faster than the revenue per vehicle was declining by. And you've seen a pretty stable plateau here around the $50,000 per vehicle revenue mark. So average revenue per vehicle not very much lower in Q1 than it was in Q4. All right, I think that is the video for today. Let me check back in with Loki, see how he's doing. He's doing all right. And I will outro and say if you've enjoyed today's video, click the like button. If you're not subscribed to my channel already, why not go ahead and subscribe to my channel? Or leave a comment below letting me know what you think. Thank you to all those who support me, either through Patreon or by joining my YouTube channel, especially Kathy Kitchler and Halter Ferguson Financial, my executive producers. And I will see you in the next one.